students. I hope that you are second PUC commerce students. Good morning to all. I would like to introduce myself to you. My name is G.C. Rajappa. I was in Marimalappa PU College for 34 years, from 1981 to 30th June 2015. I worked there as a lecturer in commerce and head of the department for more than 20 years. So now I would like to teach you second PUC accountancy. So this second PUC accountancy syllabus consists in two parts. That is volume 1 and another one is volume 2. In volume 1 we have the following chapters. That is number 1, accounting for not-for-profit organization, and secondly, accounting for partnership. In this accounting for partnership, we have the basic concepts, and then that is what you call it as the next is after basic concepts, that is reconstitution of admission of a partner, and then a reconstitution of retirement and death of a partner. After this we have one more chapter in partnership, that is dissolution of a partnership firm. And then after this we have, that is what you call it as shares. Next chapter is, that is accounting for shares. And the fourth one is, that is issue of debentures and repayment of debentures. So these are the chapters we have prescribed in this chapter, in this volume 1. And this is, as you know, I am going to request you, there are two books. Here this is Accountancy Volume 1. This is Accountancy Volume 1. This chapter consists of 6 chapters. That is what I have said now, that is about 6 chapters. And then this is Accountancy Volume 2. Again in this we have different chapters. That is, in this chapter we have, that is what you call it as financial statement of a company. And then secondly we have analysis of financial statements. And then the third chapter in this second book is, that is what you call it as accounting ratios. And then that is what you call it as cash flow statements. So now I would like to take up the first book, that is volume 1. In that volume 1, the first chapter I would like to start with this is accounting for not-for-profit organization. Not-for-profit organization. This is a very, very important chapter from the point of view of your examination, dear students. And also one more point I would like to request you. From tomorrow, you have to bring this to, you have to keep these two books, accountancy books, volume 1 and volume 2. Firstly, I am starting this volume 1 because when I start to work out the problem, so you have to keep this textbook. Just I am going to tell you the exercise number. I cannot dictate each and every problem because that runs for a page together. So therefore, while working out the problems on this chapter, whatever may be the chapter, you have to keep the textbook and you have to see the problem. I am going to work out on the board only the solutions. So therefore, from tomorrow itself, you have to keep this book, that is volume 1, accountancy volume 1. So I hope that all of you already brought. So now, accounting for not-for-profit organization is a very, very important chapter from the point of view of your examination. This is the toughest chapter. Strictly speaking, this is the toughest chapter. If you are well versed with this chapter, you can easily understand the other chapters also. So therefore, I am taking this chapter. So now, accounting for not-for-profit organization. Before we work out the accounting for not-for-profit organization, let us study what are profit organization and not profit organization. That is trading concern and non-trading concern. What we call it as non-trading concern. Trading concerns are those concerns which undertake buying and selling activities. Their main intention is to earn the profit. But here we are concerned with not-for-profit organization. So, not-for-profit organizations are those organizations which do not undertake trading activities. Their main aim is to render service to the public at large. Their main aim is not to earn profit, but to provide service to the public at large. For example, that is, as examples of non-profit organizations are hospitals, educational institutions like our Chetana PU College, any educational institution, and then what you call it as libraries, recreation clubs are the examples of not-for-profit organizations. See, these not-for-profit organizations are established not to earn profit, but to promote science, culture, art, sports. Their main aim is to promote these science, art, culture and sports. So here, these not-for-profit organizations also supposed to prepare final accounts. So now, I would like to take up the characteristics of not-for-profit organization. As in the first and the foremost characteristics of not-for-profit organization is, it provides service to the public at large. As you know, as I have already said, it provides service to the public at large, to the various organizations. And secondly, it is organized in the form of charitable trusts. Charitable trusts. And also the next one is, as you know, the day-to-day management of the non-profit organization is executed by the what you call it as a committee, executive committee. This executive committee is going to look after the day-to-day affairs of the organization. This committee is elected by the members of the organization. The members of the organization. They are going to elect this committee, executive committee, such as what you call it as the president, vice president, secretary, joint secretary, treasurer, etc. They are going to look after the day-to-day affairs of the organization. Because, as you know, in each and every organization, there are thousands of members. They cannot come and administer the day-to-day affairs of the company. So therefore, this executive committee is going to look after the administration of the organization. And the next one is, as you know, subscriptions. So where do you get the income to this non-profit organization? So these non-profit organizations are going to get their income by collecting the subscription from the members and what you call it as the government aids, donations, legacies and interest on investments. So these are the major source of income to the not-for-profit organization. And next one is, as you know, this is whatever the excess of profit. We don't want to call it as excess of profit, that is excess of income over expenditure. So these organizations, they are not supposed to distribute to the members of this organization. That amount is a surplus profit has to be transferred to the capital accounts or what you call it as capital fund. They are not supposed to distribute the surplus of the non-profit organization. And the next one is, as you know, that is, sixth one is, see, that is sources of income. And then what is the sources of income? As you know, we know that mainly the main source of income is subscriptions and then donations, legacies and interest on investments. So after this characteristics, now I would like to take up the books of accounts. The books of accounts maintained under not-for-profit organizations are mainly the first and the foremost book they are going to maintain is what you call it as cash book. That is cash book. What is cash book? As you know, cash book is nothing but a summary of the cash transactions which have taken place during a given period of time. In cash book, we record all receipts in the debit side and all payments in the credit side. It contains the opening and closing cash or bank or both the balances. And the second one is, as you know, the ledger. The ledger book is also supposed to be maintained by this non-profit organization. In this ledger book, they are supposed to show the all assets, the various assets brought in by the organizations and whatever the assets sold by the not-for-profit organizations, and all ledger accounts are to be maintained in this book called ledger book. And the next one is, that is what you call it as register of members. Register of, see, this is another important book maintained by not-for-profit organization. In this register of members book, they are going to record the name and address of all the members and the details regarding the members they are going to record in this register of members. So these are the three important books. In some organizations, they also maintain this journal. But here I hope that the maintaining of journal is not necessary. But mainly they are supposed to maintain cash book, ledger and register of members. So now I would like to take up how these final accounts of not-for-profit organizations are prepared. Unlike in the case of trading concern, they are also supposed to prepare the final accounts of their organizations. So in trading organization, we are supposed to prepare trading account, profit and loss account and balance sheet. But here, in the case of not for profit organization, they are also supposed to prepare the final accounts and they are supposed to submit this final account to the register of societies and payments account. Receipts and payments account. Secondly, income and expenditure account. Income and expenditure account. And thirdly, they are supposed to prepare what we call it as balance sheet. These are the three important books of accounts maintained by this not-for-profit organization. Now I would like to take up one by one in greater detail. First one is receipts and payments account. What is receipts and payments account? A receipts and payments account is a real account as it is concerned with the receipt and payment of cash. A receipts and payments account contains the opening cash or bank or both the balances. In receipts and payments account, we are going to record all receipts in the left hand side and all payments in the right hand side. Receipts and payments account contains both the revenue and capital items. I would like to explain later what are revenue item and capital item. So, in receipts and payments account, we are going to take both the revenue and capital items. This receipts and payments account contains the items which relates to the previous year, current year and the next year. Once again, the receipts and payments account contains the items which relates to the previous year, current year and also the next year. This receipts and payments account, as you know, it does not include the outstanding items such as depreciation, outstanding, that is what you call it as income earned but not received, expenses incurred but not paid. Only this actual cash receipts and cash payments are to be recorded in receipts and payments account. See here, in the differences between these receipts and payments represents either closing cash or bank balance or both the cash and bank balances. So this is all about receipts and payments account. Now secondly, that is income and expenditure account. This is also a very, very important account. They are going to ask question on this also. So, what is income and expenditure account? An income and expenditure account is also another important account prepared in non-profit organization. An income and expenditure account is a nominal account as it is concerned with the recording of all losses and expenses on all incomes and gains. So therefore, it is considered as, therefore it is called as a nominal account. An income and expenditure account is a nominal account. So this income and expenditure, even though we call it as income and expenditure account, we record all expenditure in the debit side or left hand side and all incomes in the right hand side or credit side. Don't confuse. In income and expenditure account, we record all expenditure in the left hand side or debit side and all incomes in the right hand side or credit side. So this income and expenditure account contains only the revenue items but not the capital items. It contains only the revenue items but not the capital items. In income and expenditure account, we are going to record all expenditure, all revenue expenditure in the debit side and all revenue incomes in the credit side. It does not include the items which relate to the previous year or the items which relate to the next year. But it contains only the items which relate to the current year. So now this income and expenditure account, as you know, the difference between the income and expenditure account represents either excess of income over expenditure or excess of expenditure over income. If in income and expenditure account, if the credit side is more than the debit side, that represents excess of income over expenditure. On the other hand, if the expenditure side is more than the income side, then it represents excess of expenditure over income. So this is all about receipts and payments account and income and expenditure account. And now I would like to take up the balance sheet. What is balance sheet? A balance sheet is a sheet prepared by non-profit organization. One thing should be noticed here, balance sheet is not an account. Balance sheet is not an account, but it is a financial statement prepared by not-for-profit organization at the end of the financial year. In balance sheet, we record all liabilities and capital in the liability side or in the left-hand side, and all assets and properties in the right-hand side or asset side. So, therefore, this is another important financial statement prepared by not-for-profit organization. So, it should be noticed here, very important point, balance sheet is not an account, but it is a financial statement prepared by the non-profit organization or not-for-profit organization to know the financial position of a business. So these are the three important points that we have learned here. One is receipts and payments account, another one is income and expenditure account, and another one is balance sheet. Now let us study the differences between receipts and payments account and income and expenditure account. This is a very important. They are going to ask this for 6 marks. Sometimes they are going to ask distinguish between receipts and payments account and income and expenditure account. So let us see the differences. This is receipts and payments account. This is income and expenditure account. Now the first difference is, as you know, a receipts and payments account is a real account, whereas an income and expenditure account is a nominal account. Second difference is, in receipts and payments account, receipts and payments account contains the opening cash or bank balance or both, but income and expenditure account does not contains the opening balances, opening cash or bank balances. And the third one is, in income and expenditure account, we are going to record all receipts in the debit side or receipt side, and all payments in the credit side. Whereas in income and expenditure account, we are going to record all expenditure in the debit side and all incomes in the credit side. And the next one is, This receipts and payments account contains both the revenue and capital items, whereas income and expenditure account contains only the revenue items, but it does not takes into account the capital items. Next one is in receipts and payments account, it takes into account the items which relate to the previous year, the items which relate to the current year, and the items which relate to the next year. But income and expenditure account contains only the items which relate to the current year, but not the previous or the next year. Next difference is, as you know, a receipts and payments account does not take into account the outstanding items such as depreciation, bad debts, etc. But while preparing income and expenditure account, we are going to take into account all these items, outstanding items, such as, that is what you call it as income earned but not received, expenditure incurred but not paid, has to be taken into account while ascertaining the income or expenditure of a non-profit organization. And then another difference is, as you know, a receipts and payments account, this receipts and payments, the differences between the receipts and payments account represents the closing cash or bank balance. The closing cash or bank balance. Whereas the difference between the income and expenditure account represents either excess of expenditure over income or excess of expenditure over income. If the income side is more than the expenditure side, then it represents excess of income over expenditure. Whereas if the expenditure side is more than the income side, then it represents excess of expenditure over income. And another one is, that is, generally this receipts and payments account does not accompanied by a balance sheet, whereas the income and expenditure account generally accompanied by a balance sheet. So these are some of the important differences between receipts and payments account and income and expenditure account. As you know, so far we have studied about the receipts and payments account, income and expenditure account, and balance sheet. So now we have to study how to prepare the income and expenditure account with the help of receipts and payments account. As you know, or in other words, we can say that what are the steps involved in preparing income and expenditure account? Steps involved in preparing income and expenditure account. Income expenditure account. Or we can say that how to convert receipts and payments account into income and expenditure account. See, this is a very, very important point, students. As you know, if you are well versed with these steps involved in conversion of receipts and payments account into income and expenditure account, you can easily work out the problems. Otherwise, you may find it very difficult. So, the first step is, as you know, go through the receipts and payments account thoroughly. In other words, pursue the receipts and payments account thoroughly. After pursuing that receipts and payments account, as you know, the second step is, see, as you know, this receipts and payments account contains both the opening and closing cash or bank balance. You delete that. You should not take into account the opening or closing cash or bank balance while converting the receipts and payments account into income and expenditure account. And then next one is, this receipts and payments account contains both the revenue and capital items. But we don't want both the revenue and capital items. While preparing income and expenditure account, we are going to take into account only the revenue items. Only the revenue items, but not the capital items. Next one is, this receipts and payments account contains the items which relate to the previous year, items which relate to the current year, and the items which relate to the next year. But we don't want the items which relate to the previous year or the next year. We are supposed to take into account only the items which relate to the current year. Only the items which relate to the current year. And the next one is, as you know, this, while preparing income and expenditure account, we have to take into account the outstanding items. That is income earned but not received, or what we are going to call it as accrued income. That is income earned but not received for the current year. That also we have to take into account. Likewise, outstanding liabilities or the outstanding expenses, expenditure incurred but not paid, that has to be taken into account in income and expenditure account. So, these are the important steps that we have to follow while converting the receipts and payments account into income and expenditure account. So now I would like to take up what are capital and revenue items. That is, capital and revenue items. This is very, very important to know the difference between capital and revenue items. Unless and until you follow, you cannot work out the problem. Unless and until you bifurcate what are capital items and what are revenue items, you cannot work out the problem. If you are able to differentiate between these two, you can easily work out the problems on not-for-profit organization. Now I would like to take up the first one is capital items. What are capital items? Capital items are those items which are not recurring in nature, which are not repetitive in nature, but we are going to get benefit out of which for a longer period. We are going to get the benefit for a longer period for this, from these capital items. For example, as you know, X-ray plant purchased by an hospital, furniture purchased by an educational institution, etc. So we are going to use this asset for a longer period. So the benefit of which is extends to the number of years. You are going to get the benefit of this capital expenditure for a number of years, for a longer periods. So that's why they are called capital items. Once again, I would like to repeat it. Capital items are those items which are not recurring in nature, the benefit of which is spread over to the number of years, the benefit of which is not restricted to a particular year, but we are going to get the benefit for a longer period. The examples of capital items are, legacy received, donation received, and then what we call it as legacy received, and then donation received, and we have to receive any amount from these are then a lottery prize amount received. So these are all the examples of these capital items. Again, these capital items may be broadly classified into two types. They are capital expenditure and capital receipts. Capital expenditure is also called as the expenditure which is incurred to acquire the fixed assets by a non-profit organization. See, as you know, capital expenditure. Again, this capital item may be broadly classified into two types. They are capital expenditure and capital receipts. Capital expenditure are those expenditure which are incurred by a non-profit organization in acquiring the fixed assets. Such as purchase of a building, purchase of a machineries, and then X-ray plant purchased by an hospitals, and then furniture purchased by an educational institutions are the examples of capital expenditure. So once again, the capital expenditures are those expenditure the benefit of which is spread over to number of years. Because when you bought X-ray plant by an hospital, the hospital is going to use that X-ray plant for a longer period. They may use that X-ray plant for 10 years or 20 years. And likewise, furniture purchased by the education institution, the benches, the chairs, etc., they are going to use for a longer period. It is not restricted to 1 year. So, all such items are considered as capital expenditure. The examples of capital expenditure are X-ray plant purchased by an hospital, furniture purchased, and then any asset purchased are the examples of capital expenditure. And now, what are capital receipts? Capital receipts are those receipts which are received rarely, from a non-profit organization, such as you know, donation received, legacy received, lottery prize amount received. Because these capital receipts you are not going to receive every year or every month. They are going to receive rarely by a non-profit organization. Now I would like to take up revenue items. What are revenue items? Revenue items are those items which are recurring in nature, which are repetitive in nature, the payment or receipt of which arises frequently by a non-profit organization. For example, fees received by an educational institution, and then what you call it, salary paid, rent paid, printing and stationery purchased. These are all considered as revenue items. Revenue items are those items which are repetitive in nature. The payment or receipt of which arises frequently by a non-profit organization, and also the benefit of which is restricted to that particular period only, for that particular year only. We are not going to spread, we are not going to get the benefit for a longer period. We are going to get the benefit only to that particular period or particular year. For such items, we are going to call it as revenue items. Again, these revenue items may be broadly classified into two types. They are what we are going to call it as, that is revenue receipts. Revenue receipts and revenue payments. Revenue receipts are those receipts. They are recurring in nature. They are frequently received by non-profit organizations. They are subscriptions received from the members. They may be received subscription monthly or quarterly or half-yearly or yearly. And then fees received from the students. Fees received from the students. And likewise, what you call it as the fees received from this, what you call it as the doctors, they are all considered as revenue receipts. And then revenue payments are those payments which are frequently paid by the non-profit organizations. They are revenue, examples of revenue payments are, as you know, rent paid, salary paid, and then commission paid, interest paid are the examples of revenue payments. The payment of which arises frequently by a non-profit organization. For example, salary paid by a college to the staff. So they have to pay every month. It is recurring in nature. It is repetitive in nature. So that is what is called revenue payments. Rent paid, electricity bill paid, and then telephone bill paid, and then what you call it as stationery purchased, etc. are the good examples of revenue payments. Finally, students, I would like to conclude to you is, you have to know the difference between capital and revenue items. Unless and until you know the differences between capital and revenue items, you cannot work out the problem. Understand? So unless you know the differentiate between the capital and revenue items, you cannot work out the problem at all. Because the working out the problem is depends upon the differentiating between capital and revenue items. Thank you, students. Thank you.